Good morning, friends. My name is Anup Nigam. I'm a technical analyst. In the last video, we learned about how do we calculate the profit or loss of the short call position. Now, in this video, we'll try to understand how do we calculate the profit or loss of the long put option. Put option is basically an instrument that gives the buyer the right to sell an underlying asset by a certain date for a certain price. The profit or loss that the buyer makes on the put option depends on the spot price of the underlying asset. So if upon expiration, the spot price is below the strike price, the put option buyer will make the profit. Lower the spot price, more is the profit. But if at the time of expiry, the spot price exceeds the strike price, then the put option buyer will let the option expire worthless. That means he will not exercise his option. Now, in this particular scenario, the loss to the option buyer will be the premium that he paid to have this option. Now, imagine that the trader buys the put option of stock X of strike price equal to 50. So, whenever we buy a put option of any strike, we sell it at a future date at an unknown price. So when we buy a particular put option, it refers to as a long put. So if the spot price goes above the strike price, then we'll make the loss. But if the spot price remains below the strike price, the trader will make the profit. Now let us try to understand the how do we calculate the put option profit. So if the trader buys a put option of strike price 2250 of stock X at a premium of 100, and if the premium goes up to 105, and if the stock X has a lot size of 1000, so in this case his profit would be 5 into 1000, that is 5000. Now let us see the put option loss. So if the trader buys a put option of strike price 0250 of stock X at a premium of 100, and if the premium goes down to 95, and if the stock X has a lot size of 1000, then the loss would be 5 into 1000, that is 5000. Now let us understand the third scenario. Now if the trader buys a put option of strike price 2250 of stock X at a premium of 50, and if at the time of expiry the spot price is greater than the strike price, and if this stock X has a lot size of 100, the put option buyer will let it expire worthless. That means he will not exercise this option, and in this case his loss would be 5000. That is to the extent of the option premium that he paid to have this put option. Now let us try to understand this with the help of the graph. So if the trader buys the put option of strike price 2250 of stock X at a premium of 100, and if at the time of expiry the spot price is below the strike price, the put option buyer will make the profit, whereas if the spot price trades above the strike price, then the put option buyer will make the loss. So guys, in this video we have tried to understand how do we calculate the put option profit or loss. So if you think that this video is informative, then please like this video, subscribe my channel, and share this video with as many traders as you can. Thank you. Dhanyavad.